Imagine yourself sitting in a parked car in a Shell gas station on High Street in Columbus, Ohio. Your tank is on fumes, says the dashboard display. The weather outside is a cold, damp Ohio evening. You pull out your phone, open the Chase banking app, and watch as the loading circle spins on the screen. And your chest feels that familiar, quiet pressure. You earn $88,000 a year, a decent salary that should land you solidly in the middle class. But the number that actually comes up on your screen is exactly $47. You're doing the quiet, nervous math in your head to see if you can afford to pump $40 worth of regular unleaded without incurring a $35 overdraft fee. This is David's usual procedure. He's a marketing manager, works 45 hours a week, pays his taxes, and can't work out why his bank account is a constant source of stress. Let's see, how does David compare to Marcus now? Marcus is a senior corporate accountant in the same Columbus, Ohio office park. He also pulls down a respectable $88,000 a year. His bi-weekly paycheck, net of taxes, is exactly the same $2,700. For now, Marcus is catching a flight to Seattle for a long weekend. He hasn't used his banking app today, and he won't use it once in the next 4 days. He doesn't need to. His bills are already paid. His emergency savings are buffered up in a high-yield savings account. His retirement contributions are automated, and his investments are compounding in the background. The difference between David and Marcus has nothing to do with willpower, intelligence, or that one is a financial monk and the other lives extravagantly. The difference is the plumbing. Marcus uses a 9-minute payday system that works like a corporate treasury sweep system, moving his cash before his spending brain has a chance to make a decision. As an accountant, my work involves managing corporate ledger routing, matching bill dates, and setting up tax-aware allocations for companies. The goal of a corporate treasury department is simple: minimize idle cash, maximize yield, and automate the routing of funds so that human error is removed. But most people do the opposite when people get paid. They deposit their entire paycheck into a single checking account, where they are vulnerable to subscription auto-drafts, impulse purchases, and lifestyle creep. They treat their checking account like a vault for storage instead of what it is, a transit hub. In this video, I will show you the exact 9-minute routine that accountants use to manage their personal cash flow on payday. By the time you are finished with this blueprint, you will have a complete step-by-step system for building wealth on a median income that will take you less than an hour to set up and about 0 hours per month to maintain. Not theory, not a philosophy. An account name and fund ticker system with contribution priority. Let's get started. To understand why you need this routine, we have to look at a fundamental law of human behavior known as Parkinson's law. C. Writer, who first devised it, Northcote Parkinson's law states that work expands to fill the time available to complete it. The personal finance corollary is that expenses will grow to match income. When you have cash in your main checking account, your brain sees it as money that you can spend. It doesn't matter if you say to yourself, "I'm going to save $500 this month." As long as that $500 is in the same account you use to buy groceries and pay for gas, your subconscious will see it as disposable income. The checking account becomes a huge holding pond, and before you know it, the money is spent on little things that are easily forgotten. In corporate finance, no treasury department would ever leave cash idle in a zero-interest operating account. They know that cash is a node, and every dollar must be directed to its most productive use now. Not putting your money to work is a mental risk and a mathematical certainty of loss. The Bureau of Labor Statistics released data in June of 2026 showing the headline consumer price index for all urban consumers is running at 4.2% year-on-year. The core consumer price index, which strips out volatile food and energy costs, rose 2.9% year-over-year. Personal consumption expenditures inflation is projected at 4.1%. with core personal consumption expenditures at 3.3 to 3.4%, according to the Bureau of Economic Analysis. In plain English, this means that every dollar sitting idle in a traditional checking account is actively losing purchasing power. If you have $5,000 in a regular checking account earning 0.01%, you are quietly and invisibly taxed by inflation. You are voluntarily reducing your wealth while the bank is making a spread on the difference between what they pay you and what they make on lending your money out. The financial system is based on what I call the extraction model. Modern commerce is designed to make spending as easy as possible. Subscription services, targeted ads, one-click checkouts, and buy now, pay later options are all designed to milk your loose cash. If you don't have a conscious system for routing your money, someone else will do it for you. Your gym, your streaming services, your local coffee shop, and your landlord all have automated systems to take their share of your paycheck the minute it lands. The only way to fight it is to build your own extraction system. You have to move your money to your own balance sheet before the rest of the world can claim it. That's the importance of the transit hub model. Think of our checking account as a temporary clearing account that should be close to zero at the end of each pay cycle, with every dollar swept into its designated home. We need a baseline checklist before we can put the payday routine in place. You cannot build a sound treasury system on a flimsy foundation. The first and foremost requirement is a starter emergency fund of $2,000 to $2,500. I hear personal finance commentators constantly talk about the need for 3 to 6 months of living expenses before you do anything else. The ideal is to have a full emergency fund, but if you wait until you've built up a $20,000 cash buffer before you start investing or paying off high-yield debt, that's a recipe for paralysis. To start, a starter emergency fund of $2,000 to $2,500 is your financial firewall. It's enough cash to cover the cost of the radiator that blows, the tooth that needs a root canal, or the flight home for an unexpected family event. This buffer means that when life happens, and it will, you won't have to turn to credit cards and slide back into debt. The second requirement is a blunt mathematical rule. All credit card debt and consumer loans with an interest rate of greater than 8% must be thrown out. Well, let's look at the data. The latest reports I've read from the Federal Reserve show that the average annual percentage rate on credit cards combined is now in the 23 to 24% range. New credit card offers are averaging 25.17%, and revolving balances that are actively assessed interest are averaging 21.52%. Don't invest in index funds with a historical inflation-adjusted return of 7% when you have debt costing you 23%. It is mathematically equivalent to walking up a down escalator with lead weights. This is a guaranteed risk-free 23% return on your money, paying off the credit card balance that is at a 23% interest. There is no Wall Street fund manager who can promise you a guaranteed risk-free 23% return. Credit card debt is not a relaxed bill to chip away at. If you have credit card debt, that is a household emergency that needs to be put out before you start investing. That might cause some viewers to say, wait, should I still be contributing to my company 401k to get the employer match while I pay down credit card debt? That's the one exception to the rule. If your employer offers a match, say 50 cents on the dollar up to 6% of your salary, that's a 50% return on your money. A guaranteed 50% return beats a 23% interest charge. But, more than that, every dollar that is left over must be used to destroy debt. If you're debt-free or only have low-interest debt such as a mortgage or student loans below 8%, and you have your starter emergency fund of $2,000 to $2,500 in place, you are ready to start the routine. The requirements are now satisfied, and we can move to the step-by-step sequence of the payday routine itself. Step 1. Reconciliation of ledger. Reconciliation is a process in corporate accounting where bank records are matched against internal ledgers to ensure accuracy. This is the first thing you do on payday morning in your personal routine, and it takes exactly 2 minutes. You log into your main checking account and compare the current balance to your ledger, which could be a simple spreadsheet or a tracking app. You're searching for fraud, subscription renewals you forgot to cancel, or errors. More importantly, you are calculating the baseline net cost of what you are doing today. That means figuring out exactly how much money you need to cover your fixed, non-negotiable living expenses for the next pay period. This baseline verification leaves no room for ambiguity. You know exactly what went out in the last period, and what has to stay in the account to keep the lights on in this one. This isn't about limiting your spending, it is about knowing what you're dealing with before you spend a single dollar. Step 2 is to establish the clearing account. A clearing account in corporate treasury is a temporary account where funds are accumulated prior to being swept to their final destination. You must convert your main checking account to a clearing account. The clearing account operates on the principle that the account should have a near-zero target balance at the end of each pay cycle. You don't keep wealth in a checking account. You break the transit hub model if you maintain a large, stagnant balance in your checking account. This is a psychological trap because your brain sees the visual presence of extra cash as more wealth than you really have and causes unnecessary discretionary spending. You want to maintain a small fixed buffer, say $100, to prevent accidental overdrafts from small automatic drafts. Every other dollar that comes into this account has got to have a ticket out on payday. The plan is to make the account a clean conduit, not a reservoir. Step 3. Setting up direct deposit splits. Most people deposit their whole paycheck into one checking account and plan to manually transfer money into savings or investments later in the month. This is a failure of behavioral design. The money is gone by the end of the month. To prevent that, you have to take your money to the source of the payroll before your spending brain can interfere. To do this, log into your employer's payroll portal, such as ADP or Workday, and update your direct deposit information. Most payroll systems will allow you to divide your deposit among different accounts. You could tell it a flat dollar amount or a percentage of your salary to go straight to your high-yield savings account and your brokerage account, and the rest would go to your primary clearing checking account. You don't see that money in your checking account because you divide your savings off at the payroll source. You can't spend what you can't see, and the temptation to change your savings rate is removed from your daily life. Step 4. Establish accrual sinking funds. In business accounting, an accrual is an expense that is recognized before it is paid. For example, suppose you have a $1,200 a year car insurance bill. That is not a $1,200 emergency in December. It is a $100 liability every month. Most people face these non-monthly expenses as sudden emergencies, tapping their emergency funds or relying on credit cards to cover them. This is solved in the accountant routine by accruing sinking funds. You find all your predictable, non-monthly expenses, like car insurance, property taxes, annual subscriptions, holiday gifts, and home maintenance. You add up the annual cost, divide by 12, and deposit that exact amount into a separate high-yield savings account each month. Current competitive high-yield savings accounts offer annual percentage yields between 4.00% and 4.20%, with the top online platforms offering annual percentage yields as high as 5%. The savings yield for the average is 0.61%, or traditional bank savings yields of 0.22% to 0.24%. You earn interest on your accrued liabilities by using online savings accounts such as SoFi, which pays 3.8% with direct deposit, or Ally Bank at 3%, making sure that when the annual bill shows up, the cash is already there waiting to be spent. Step 5. Apply the tax-aware allocation priority. The order in which you invest your money is incredibly important for tax efficiency and immediate return on investment. First and foremost is your employer-sponsored retirement plan, IEA 401k, up to the max employer match. If your employer matches dollar for dollar up to 4% of your salary and you don't contribute that 4%, you're turning down a guaranteed 100% return on your investment. It's the nearest thing to a free lunch in the financial universe. The IRS standard elective deferral limit for a 401k is $24,500 for the tax year of 2026. If you're between the ages of 50 and 59 or 64 or older, the catch-up limit is $8,000, bringing your total limit to $32,500. If you are between the ages of 60 and 63, the catch-up limit under the Secure 2.0 Act is $11,250, for a total contribution of $35,750. The maximum combined contribution from an employee and his or her employer is $72,000. You don't have to max this out right away, but you have to get the full match before you can move to the next tier. Your second priority in the allocation sequence is your health savings account, or HSA, if you are signed up for a qualifying high-deductible health plan. An HSA is the only account of its kind that has triple tax advantages. Contributions are tax-deductible, growth is tax-free, and withdrawals are tax-free when used for qualified medical expenses. The self-only limit for 2026 is $4,400, and the family limit is $8,750. If you are age 55 or over, you can add another catch-up amount of $1,000. To qualify, your high-deductible health plan must have a minimum deductible of $1,700 for self-only coverage or $3,400 for a family. The out-of-pocket maximums cannot exceed $8,500 for self-only or $17,000 for a family. The third priority is a Roth Individual Retirement Account, or Roth IRA, up to the annual limit of $7,500. If you are 50 or older, you can add another $1,100 to that, for a total of $8,600. With a Roth IRA, you put after-tax dollars into the account today. Then the money grows tax-free, and you can withdraw it tax-free in retirement. Once you have maxed out these tax-advantaged accounts, the remainder of your investment money should be used to pay off expensive debt or invested in a taxable brokerage account holding low-cost index funds that track the S&P 500, like VOO, FXAIX, or SWPPX. Step 6 is aligning the payday calendar. Corporate treasury. Here, cash flow matching means matching cash inflows with cash outflows. Most people have a structural cash flow mismatch. They get paid on the 1st and the 15th, but their rent is due on the 1st, car payment is due on the 10th, and their utility bills are sprinkled throughout the month. This mismatch creates times of artificial scarcity and stress. The accountant routine eliminates this by synchronizing your bill due dates with your payday. Call each of your service providers, utility companies, credit card issuers, and mortgage servicer or landlord. Most will allow you to change your monthly billing due dates. You want to ask that all of your bills come due 2 to 4 days after your paycheck hits your clearing account. This alignment means your cash flows in, sits in the clearing account for 48 hours, and is immediately swept out to pay your bills. This shortens the time between paychecks, stops money from sitting around, and guarantees you'll never have to stress about having enough cash to cover a bill that arrives in the middle of a pay cycle. There are many common mistakes you can make when doing this routine that will hinder your progress. The first mistake is letting extra cash sit in your checking account. As we have established, idle checking balances are a psychological hazard and an inflation target. You check your checking app and see a comfortable balance. Your brain gets a false sense of security. You're far more likely to accept a dinner out you don't need or upgrade a subscription service because the money's there. In corporate accounting, this is called cash drag, the downside of holding cash rather than investing it. By keeping your clearing account balance close to zero, you force yourself to live within the operational baseline you calculated in Step 1. Any cash above that baseline buffer needs to be swept into a high-yield savings account or brokerage account on payday morning. If you don't have the money in your checking account, you can't just go out and spend it on a whim, and it will earn a return instead of losing value to inflation. The second mistake is to get your bills due at the wrong time. Many people schedule their automated savings and bill payments to occur on different days of the month, or they stagger their bill due dates. If you get paid on the 15th, but your student loan payment is due on the 14th, you're creating an artificial cash flow crunch. So you need to have a big balance in your checking account 2 weeks out to cover that payment that's coming up. And that money is open to impulse spending. If you can get all your due dates to line up for 2 to 4 days after your payday, you have a cash flow event. Money comes in, the automatic transfers and bill payments kick in, and within 48 hours the account is back to its baseline cushion. It saves you the headache of keeping track of when things are due and makes sure your money is always working at the highest efficiency. The third mistake is to depend on voluntary saving instead of automated routing. Too many think they can build wealth by simply promising themselves they will save what's left over at the end of the month. This is a psychological failure mode because saving becomes a second-place priority, competing against every immediate desire you experience over 30 days. When saving is voluntary, it takes willpower, and willpower is a limited cognitive resource that is easily depleted by stress, fatigue, or a bad day at work. The accountant routine substitutes automatic plumbing for willpower. Automated sweeps in your checking account and direct deposit splits at the payroll level take the decision out of your daily life. Saving is automatic. You don't have to choose to save. It happens before you even see the cash. You have to live off the leftovers, so you are automatically in sync with your long-term goals. Mistake 4. Not accounting for the third paycheck phenomenon. If you are paid bi-weekly or every 2 weeks, you will have 26 paychecks in a year. Most months are a little more than 4 weeks long. That means you will have 2 months each year where you get paid 3 times instead of 2. Most people consider these 3 paycheck months a windfall, using the extra check as a windfall to pay for vacations, electronics, or eating out. In corporate treasury, this third paycheck is known as an acceleration event. Your monthly living expenses are covered by your first 2 paychecks, leaving your third paycheck as 90% discretionary cash flow. If you let this money sit in your checking account, it will surely vanish into lifestyle upgrades. Instead, the accountant routine says you must sweep this entire extra paycheck directly into your high-yield savings account to build your emergency fund, or into your taxable brokerage account to buy index funds. Sweep this extra check, and you can accelerate your wealth-building timeline by years, turning a random bonus month into a huge step forward on your balance sheet. To understand why the discipline of this routine is worth the small effort of setting it up, we need to understand the math of compound interest over a multi-decade horizon. Here's a walk through the milestones of what happens when you regularly put $500 a month into a broad market index fund tracking the S&P 500. We will assume a historical long-term average return of about 10% nominally, which amounts to about 7% after inflation. After paying out $500 a month for a year, you will have paid in $6,000, and your balance will be about $6,200. Then it seems not much is happening at this point. You may be tempted to abandon the system, thinking the small growth is not worth the sacrifice. This is the flat part of the exponential curve where your manual contributions are 95% of the total value. But let us watch the curve begin to bow. Your portfolio will be approximately $86,000 with regular monthly contributions of $500 for 10 years. $60,000 of that will have come from you, and compound interest will have added $26,000 of growth. Now let's fast forward to year 20. You will have contributed $120,000, and your account will have grown to about $260,000. Now compound interest has added $140,000, more than the total amount of money you put in manually. The engine has taken control. The numbers are truly staggering at year 30. However, you will have grown the balance of your portfolio to around $610,000, and your lifetime contributions will have been $180,000. The compounding effect has added growth of $430,000. In the last 10 years alone, your portfolio grew by $350,000, which is almost twice your total lifetime contributions. Now let's double that monthly contribution to $1,000 a month, which is a realistic target for a household that implements the full accountant routine, eliminates high-interest debt, and captures tax-advantage splits. With a 7% inflation-adjusted return, you will have accumulated about $174,000 in 10 years' time. That figure reaches $520,000 after 20 years. And after 30 years of consistency, your automated system will have accumulated $1,200,000 in purchasing power. This is the power of the exponential curve. The last years do most of the work, since the interest is calculated on a large, accumulated base. But you can't get to the vertical part of the curve without first going through the flat, boring years at the beginning. And this is why starting early is the single biggest advantage you can have. If you start your investment routine 10 years later, you will cut your final retirement balance in half, meaning you will have to double or triple your monthly contribution in your later years just to catch up. Here I have to issue a dire warning. While the historical long-term average return of the S&P 500 over the last century has been about 10% nominally, the market does not move upward in a straight line. There will be years when the market drops 20%, 30% or more. So in March of 2020, in the early panic of the global pandemic, the S&P 500 dropped 34% in a matter of weeks. If you don't have a starter emergency fund of $2,000 to $2,500 and a larger high-yield cash buffer behind it, you'll be forced to sell your index funds at a loss during a market downturn to pay your rent or buy groceries. This is how retail investors lock in permanent losses. This vulnerability is avoided by the accountant routine of separating your long-term investments from your short-term operational cash. Market volatility doesn't matter to you because you don't touch the investment account. You ride the index funds through the downturns, knowing that historically the market has recovered and moved to new highs every single time. Now let's discuss how to construct the automation layer that makes this payday routine self-sustaining and eliminates future decision-making. The heart of this layer is the payday sweep. You have an automatic transfer from your bank set to take place the day before your paycheck arrives. This transfer takes any excess cash over and above your baseline buffer, for example, $100, in your primary clearing account directly to your high-yield savings account or taxable brokerage account. This means that you start each new pay period with a clean slate and no tempting extra cash lying around. You also create your payroll direct deposit splits to automatically take out your fixed savings and investment amounts straight out of your paycheck. Your 401k, your HSA, your Roth IRA, the money for that comes out at the source. You never get to spend it because it never gets into your clearing account. Your clearing checking account is credited with the balance, and your aligned bill payments are automatically drafted within 48 hours. The system operates completely on autopilot. You would need to adjust your tax withholding using your W-4 form to take full advantage of the system. The new tax law, called the One Big Beautiful Bill Act, or OBBBA, is effective for the current tax year of 2026. There are some big updates you can take advantage of to increase your take-home pay on payday. The standard deduction has been increased to $16,100 for single filers and $32,200 for married filing jointly. There is an additional senior deduction of $6,000 per person and a child tax credit of $2,200. More importantly, the new law provides for several huge above-the-line deductions that can substantially lower your taxable income. You get a qualified tips deduction to deduct up to $25,000 of tips above the line. There is also a qualified overtime deduction, which permits a deduction above the line up to $12,500 for single filers, or $25,000 for married couples filing jointly. You can also deduct up to $10,000 of passenger vehicle loan interest above the line. And the state and local tax, or SALT cap, has been increased to $40,000 for households earning less than $500,000. It creates Trump accounts for kids, seeded with a $1,000 deposit from the federal government starting July 4, 2026. Private contributions are capped at $5,000 a year. If you qualify for some of these deductions, like the overtime deduction or the tips deduction, and you haven't updated your W-4 withholding form with your employer, chances are you're overpaying your taxes throughout the year. Basically, you are lending the federal government money without interest. Then in April of the following year, you get a big refund check. Corporate accounting interest-free loans are a cash flow failure. You want that money on your balance sheet on payday, not hanging out in the government's treasury. Change your W-4 to reflect these new deductions, and you could be getting hundreds more dollars in your bi-weekly paycheck. That additional cash flow can be sent directly into your payroll splits to fund your Roth IRA or your high-yield savings account, so compound interest can work for you immediately rather than waiting on a tax refund. We also need to consider the recent changes to federal student loans, which will take effect on July 1, 2026. These changes will affect how you plug in your monthly debt payments during your calendar alignment step. The new guidelines have eliminated Grad Plus loans for new students and capped Parent Plus loans at $20,000 per year per student, with a lifetime limit of $65,000. The lifetime maximum for an undergraduate loan is $257,500. Notably, a court order on the 10th of March, 2026, dismantled the Saving on a Valuable Education Plan, or SAVE plan. On July 1, 2026, the Department of Education began sending transition notices. If you're in the SAVE plan, you now have a strict 90-day window to switch to the Repayment Assistance Plan, or RAP, or the Tiered Standard Repayment Plan. If you do not select a plan within this 90-day window, you will be automatically assigned to the default standard repayment plan, which may result in a dramatic increase in your monthly payment and disrupt your cash flow baseline. As part of your payday routine setup, you'll need to check your student loan portal to see if you received one of these transition notices. If you have done this, you will need to select the repayment plan that fits your cash flow capacity and recalculate the baseline net cost of your operations. When you find out your new monthly student loan payment, you contact your loan servicer to align the payment date to be 2 to 4 days after your payday. Don't miss out on this transition. If you're on the standard repayment plan, the sudden increase in your monthly obligation can eat through your clearing account buffer and cause overdrafts. Choose a repayment option and preset a payment date to maintain full control of your cash flow and keep your treasury system in good working order. Now you see the whole system. There is nothing exciting or high stakes about building wealth. It's not about market timing, picking the next hot stock, or trading crypto in the middle of the night. That's the boring strategy. The greatest investors in history weren't those who took the most risk or spent the most time analyzing charts. They were the ones who built a simple, boring system and were disciplined enough to keep away from it. Ronald Read didn't have a lucrative job or a team of financial advisors. He had a used car, a brokerage account he put money into regularly, and flannel shirts, a used car, and a brokerage account that he consistently funded and ignored for decades. The financial industry wants you to believe that investing is complicated because they can sell you the complexity for a fee. If you have a self-reconciling clearing account, direct deposit splits, and automated your investments into low-cost index funds like VOO, FXAIX, or SWPPX, you have left their extraction model. You stop paying the complexity tax. You start keeping the growth for yourself. The math is not waiting for you to be ready. Every month you wait to put this system in place is a month of compound interest you will never get back. You can't buy back the time you've lost, but you can buy the time you have left. Tonight, I dare you to audit your bank accounts. Check your transactions for the last 30 days and calculate a baseline net cost for your operations. If you're still earning 0.2% at a traditional bank, open a competitive high-yield savings account. Log into your payroll portal tomorrow morning and establish your direct deposit splits. Call your creditors and adjust your payment due dates so that they are 2 to 4 days after your payday. It takes less than an hour to set up, but the effect on your financial life will last for decades. With the plumbing in place, you can switch off your banking app, hop on your flight, and let the system do its thing in building your freedom in the background. The board is in sight. The rules are clear. The move is yours to play.